Hey everyone, welcome back to the Mike Rosehart Show. We're live again for another installment, and today I'm talking about what I'm seeing in the market. And I'm seeing things here in Ontario specifically are not doing well in real estate. We're seeing cottage country properties drop up to, in some cases, 60% in value in the Muskokas all around. We're seeing a big drop in value between 5 and 60%, depending on how rural it is, depending if it's full season, depending on a number of factors. But really a great opportunity right now in general, in Ontario specifically. And I'm gonna tell you why I think that this winter is gonna be one of the best opportunities we've had in decades. Since I've started my real estate investing career in 2012, early 2012, I bought my first property. And I've been hunting and looking through so many listings and negotiating. It took months and months before I finally put a deal together. And back then it could take months of negotiating and things didn't move that quickly. And then it was like that in 2013, 2014, I continued to invest in real estate, 2015, 2016. Things got crazy in end of 2016 and 2017. For the first time in my market, there was heat. It was a buyer's market. And so for the next 6-7 years, I'd had my first 7-8 properties in a more of a buyer's market. And then it became a seller's market. Now it's a buyer's market again. So as a buyer, you can negotiate, you can throw in quirky terms, you can put in whatever you want, vendor financing, you can negotiate on the price hard, you can go 10-20% off asking, no problem. There's no more paying over ask anymore. It's done, unless someone really priced a listing or mispriced a listing, I suppose. Price is so low that it's mispriced. But there's a real opportunity here, guys. I'm seeing prices that I haven't seen since 2020 on some of these properties. Some stuff I'm seeing like 2019 pricing. So we just erased 4 years of the hottest bull market in a year. Gone. That's interesting to me. The reason I say that is because Canada's current immigration plan is we're taking about 100,000 people a month, and we're not creating more than about 10 or 20,000 units. So there's a huge shortage of people coming in to available housing, and the government's not getting out of their own, they're tripping on their own feet. They're not going to do anything to solve this crisis. So there's going to be a pent-up amount of demand as rates fall. And that falling point is coming. Bank of Canada today paused. Continued quantitative tightening though. So they are still tightening things. They are still reducing the monetary supply. So when you reduce the monetary supply, what ends up happening is things get tight for everyone. There's less printed money to flow around. People have less money to throw around. Price action falls. The thing is, here in Ontario, our GDP is largely driven by real estate and real estate related services. And when those things are starting to crash, we had a big peak in May. I remember I told you guys last fall, always November, December is our seasonal low time. Real estate popped 12% up. We're losing all those gains and testing new lows again this winter. I think it's going to be the buying opportunity of a century. And so I'm super excited. Really, really excited for the opportunity to just go hard. And so I'm going to throw this out here, guys. I'm going to take a little break. I'm going to finish up all the projects I have going on. We have over 15 projects that I want to finish off, get them sold, clean slate, probably keep 5 or 6 of them that are rentals. They're like 1% real cash flow. We may sell them, I don't know. But I'm going to clean house, refinance, pull all the equity back out, and have a big, huge bag of cash ready to buy the dip this winter. I'm so excited. I'm going to buy 200 units. Heard it here. I'm going to sell everything. It's more of a dramatic story if I can get down to 0 units or very low number of units and then buy 200 units. So we're going to clean house like I always do, sell it all, clean slate, and then boom, we're going to go hard. I'm going to show you guys how in a year you can get 200 units locked up under contract. So there will be opportunities if you're following along to join me and take advantage of this. So there's an opportunity here. You can buy real estate yourself. I'm totally here for that. I'm totally here to every week to give you advice, whatever you need. That's what this channel is about. But if you don't want to do that, if you're like, hey, I don't want to, or I can't find good deals, but Mike can, reach out. If you've got capital, I'll pay you a fixed amount of return. Not yet. I don't want any capital right now, but if you have capital or you're looking to get capital and you want to partner up on some deals, there will be opportunity for me to interview a few people to bring them into some larger multifamily projects. I'm going to go into big deals. So I'm going to start looking at 10 plus units, ideally 20, 30 units, 40 units. I want to buy stuff that's got Airbnb potential, that I can go Airbnb, but I could also do long-term. So I want to have multiple options. I'm not going to niche myself down. I want to be able to have multiple exit strategies and multiple different strategies in case, say, Airbnb gets banned or it dies. You want to have that flexibility to switch to a furnished monthly rental or something to that effect. So I'm excited about that. I'm excited for the break that's coming up because I've been pushing myself really hard to get my dream house the way I want it. I've been working on this pool and pool house. I've been working on several flip projects, and I've been actively, on the microing side of things, micromanaging a lot of these projects. And I'm excited for a break. Life's been really busy, so I'm excited for the break. Take that break when these properties sell, big time cashed up. You're going to hear it here. I'm going to quit trading. So I will not be stock trading anymore by the end of this year. I'm hoping I'm going to see this short through. Usually September's a really weak month. Usually things are weakened at the end of the year. I may keep a position, but I'm not going to be actively trading it. I'm going to try to pull out about 60 to 70% of my stock portfolio and redeploy like 90% of my net worth into real estate and lending. Those are my two focuses. So I think I'll be able to fund also. If you guys are on the other side of things, well, I might want to raise capital for some of my deals. I might have an excess of capital if I can't find enough deals to fund, and you find a great deal and you want to bring me on as a partner, reach out to me. I'm also open to that. I think it's going to be pretty sweet. I think that there's going to be really good opportunity to buy this dip. I think probably the writing's on the wall. The challenge right now is this: we're in the rock and the hard place, and so inflation's come down to like 3%. It's probably going to have a bit of a resurgence, sadly, and then we're going to see, basically, I think we're going to see oil is $90 a barrel. It touched over for a few minutes there, and it probably might even get $100 a barrel. And if it does, the cost of goods are going to rise dramatically because transportation, any service-based business, any commuting, even plastics are related to oil, anything techy. A lot of the tech stuff components are shipped. Again, shipping and freight are oil related. So a lot of our costs in our economy is oil driven, and OPEC and Russia too have just cut production further to exacerbate things and make it a little bit worse for the US. So there is potentially some fear upcoming. Use that fear to negotiate great deals on businesses you're going to buy, on real estate. At the same time, though, it's interesting. In like the Florida market compared to the Ontario market, I'm going to talk about the US versus Canada. In the US, most people have 30-year fixed rate mortgages. And so they're locked in at like 3.5% for 30 years. And it's most of the time in the US, you can sell the house and the other person can assume the mortgage without the bank's permission, and they don't even pull the loan. And not only that, you can assume it with the bank's permission too. So these 30-year notes go with a lot of these properties, as well as just a lot of cash buyers in the US as well. So there's just, this interest rate thing hasn't affected residential hardly at all in the US. But here in Ontario, the average mortgage is a 3-year fixed on average. Some people do 1 year, 2 year fixed. A lot of people do a 5-year or 4-year fixed. But the most people do is like 5-year. You sometimes see a 7 or 10 year fixed, but it's really expensive and we rarely see it. About half of mortgages in Ontario and in Canada are variable, a little bit under half. And during the peak of the low rates, it was a little bit over half. So right there, half of the mortgages are now double or triple the payment they were before. People are suffering in Ontario in a way that they aren't in the US. On top of that, everyone who's on a 5-year fix that they locked in 2020, that's coming up for renewal next year. Oh no, they're going from 3% now to look at 6%. Their payments are gonna be double. They're paying $3,000 a month for their mortgage payment. It's now $6,000 a month, which, like, if you're an entrepreneur, you got lots of extra money bags, you're fine. But a new report just came out, 50% of Canadians are living paycheck to paycheck. Half of all Canadians are paycheck to paycheck right now, and it's about to get a lot worse this winter. We're gonna remember that every year, 20% of fixed rate mortgages renew because, again, average term between 3 to 5 years. So every year, about 1/5 of them renew. We've now had over 50% of all the fixed rate mortgages renew into this new interest rate environment. Plus all the half are variable that already exist. That means 3/4 of all mortgages have now gotten to the point where they're on the new rates. How many months can Canadians put things on their credit card, max out their line of credits, borrow from friends and family before they're finally tapped out and they have to sell their house, they have to downsize, they have to become renters? By the way, interesting trend, rents are skyrocketing right now. Shelter is increasing in price because inflation's out of control. So rents are increasing, prices are falling. That is a golden opportunity. The last time rents increased was here in Ontario. We raised the minimum wage from $10 to $15, and I called it out on the channel. If you go back a couple years ago, I think it was like 2017 or 2018, they did a series of increases, and I was like, guys, I'm so bullish on real estate. I'm so bullish on rents right now. Don't lock in your rents. Try to get like students so you can refresh your rents, because rents are going to come up in a big way. That was because they raised the minimum wage 30%. What happened? Rents went up 30%. When you increase minimum wage, they think it actually makes people's lives better. It doesn't. because people have more money to spend. They bid on apartments. There's only a certain supply of apartments. They're not creating any more housing. In fact, they're letting more people and immigrants into Canada. We have a challenge where there's just too many people, not enough inventory. And if they're making more from their job because inflation's driving wages up, we're going to see rents proportionally increase. But not only that, people who used to be homeowners no longer can qualify. They used to be able to qualify. If you made $100,000 a year, you could qualify for an average house in Ontario. If you make $250,000 a year, you can't legally qualify for an average house in Toronto or Vancouver. You have to be a renter. If you're a doctor or a lawyer, you can't afford to own a home in most of the major metropolitans in Canada, specifically on Toronto and Vancouver. That's a problem. That leads to an increased, a bunch more renters that are looking to rent. And so the rental market is being flooded with applications. There's not enough available housing. It's a real struggle. And then on top of that, people who were buyers before can't. So there's just no demand on the buy side for real estate, which means you can negotiate dirty deals. And it means on the multifamily side, interestingly, a lot of those notes are renewing too. And people who were, had properties that are a 3 or 4 cap rate, when you could borrow at 3 to 4%, it made sense. You could, your mortgage payment pretty much was covered by your rents coming in. Now all of a sudden, you're trying to sell your building for a 3-4 cap rate, and you have to borrow at 6. It doesn't make any sense. All of a sudden, the math doesn't make sense using leverage. So now these people are like, well, I might as well sell a building. I'm not going to hold a building that loses me $5,000 a month. Like that's the situation in multifamily. So and they can't get their rents up because here in Ontario we're on rent control. So they're stuck with frozen rents. So there's an opportunity, again, another opportunity for guys like us to go in, girls like us, whatever, to go in and to take these buildings over from these tired landlords. Say, here's a nice payday for you. Things are getting worse. We're losing any more money. We're gonna take this building over. You go in there and you turn those tenancies over. You double, when the rents were $900, now they're $1,800. You get a huge amount of increased cash flow, and that leads to a big increase in your NOI, your net operating income, and that is how you build value, real value. If you go into a building and all the rents are $900 a unit, and you go and turn them into $1,800 a unit, you get all the units turned over, your building's worth double. I mean, there's a slight premium you're going to pay for potential market rents, but for the most part, buildings trade on based on their current rents. So if you can double the rent without changing the expenses at all, because buildings occupy the same number of people, so heat's the same, hydro's the same, et cetera. So property taxes are the same. And by the way, net operating income doesn't include mortgage interest. It assumes you own the property in cash because everyone finances properties differently. So multifamily is designed for factoring out interest rates. It's just looking at the building without a mortgage, because there's a lot of the multifamily space, people use weird financing, so they couldn't pick a standard rate that says this is fair. So what they do is just assume that everyone just buys it in cash. And then if you decide to put financing on, you compare that to your current cap rate on your net operating income. But there's a huge opportunity here, guys, that I haven't been this bullish. Like, looking at a lot of data, I was like, I just keep seeing a trend down. I'm like, I don't know where the bottom is, and it's probably gonna go lower. I'm still short-term bearish, but I am long-term perma-bull. I am so bullish on real estate in the next 5 years, the next 7 years, here in Ontario specifically. And I think that there's going to be a really big opportunity to negotiate some great deals this winter. And so I'm preparing. I'm still selling a few properties. I'm preparing for cash to buy. Do I think we're going to get a huge drop? Like, no. Probably the average price will drop another 5 or 10%. Probably 15% maximum, I would say, this winter, because you get the seasonal shift from May to December of like a 10% seasonal drop we don't really get, plus another 5% depreciation. So probably 15% of a drop we'll see. But on a $500,000 house, that's $35,000 in your pocket that you're going to get to be able to negotiate. And that's not every house, that's some houses, but you can use this fact that no one is buying right now, no one is qualifying, to buy and negotiate really, really deep discounts where you couldn't before. So it's a really great opportunity right now. I'm super excited about it. I think that if you can get cash together, you should. If you have properties that you can hold for the next 5 years, hold them. I'm extremely bullish on that too if they're cash flow positive, but refinance them, get cash ready. This is the time where you don't have properties paid off in cash. As I say that, I have like 7 properties right now paid off in cash. So on one hand, I want to listen to the Dave Ramsey angel on my shoulder who's like, reduce debt, blah, 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 pay down your debt, which is what I was doing. I've been paying down almost all my debt. But at the same time, it's like, would I rather have 1 property in cash or 5 properties 20% down? Hell yeah, 5 properties 20% down. So I know in my core, debt is only bad if you're a bad performer. Leverage debt makes bad investments much, much worse, but it makes good investments way better, because when they double in value over the next 5 to 7 years, you have 1 property with 500 grand, Let's call it $1 million property. $1 million property worth $2 million. Your $1 million has doubled in value over 7 years. If you have 5 properties that you bought with 200 grand each, you took $1 million and you bought 5 $1 million properties. They're now worth not 5 million, but 10 million in say 7 years. All of a sudden you pay back all your debt stays the same, it got paid down over the time. So maybe you had 4 million in debt and 1 million in equity when you started, but you now have $5.5 million in equity. So instead of having $1 million in profit, you have $5.5 million in equity by buying 5 buildings at 20% down versus 1. That's huge. That is massive game changer. Where it's dangerous and where Dave Ramsey went bankrupt in the late 80s was he was buying stuff that didn't cash flow, taking a lot of risk and applying leverage to that. That doesn't work. But if your time horizon is long and you can hold this building and it can cash flow, then it doesn't matter. Mortgage debt is non-callable. So the lender can never call it on you. They don't want the properties back in a recession. They want you to keep paying your mortgage payment and they want to work things out with you. That's the truth. So anyway, that's what I want to share with you guys today, a little bit of that. I'm gonna go to the Q&A for a sec and then we'll keep diving deeper on this. We can talk stocks too a little bit, but I'm trying to focus on real estate because again, that's the area where I have a real alpha, a real edge. In the stock market, it's really hard to have an edge. There are guys who spend 16 hours a day, who have teams of people doing research for them, and you're competing against the smartest quants, computers, PhD experts in finance. It's a competitive world, and there's a lot of insider trading and insider information that you don't have. And even if you could be as good as them and perform at their level, if you're like the smartest guy, high IQ, all this, and you compete at their level, you still have to put in the hours that they put in. So if you're not going to put in 12 hours a day, 7 days a week, you're not going to grind it, you're going to lose. So you're the smartest fucking person I've ever met in my entire life. If you don't put the effort in, you're going to fail. And that is part of why I don't want to be a trader. I don't want to put that effort in. I put that same effort into real estate. Like if I put all that effort into stocks, I might generate a 1, 2, 3% yield above like an alpha, an edge, a small percentage of gain over a 25-year period. You get a few percentage points a year above the index, which is amazing, by the way. Anyone who can outperform the index by a small amount over a 25-year period is like Warren Buffett and can raise as much money as they want. The truth is most traders can't. They'll have 200% swings up and then 100% swings down, or they'll have many drawdown days. And it just, if you look at over the long period of time, there are almost no traders who outperform the index over the long period of time if you give them a good amount of capital to work with. They can scale to a certain point, but when the portfolio gets large enough, they almost always blow up. So that's just the data. There are anomalies, there are exceptions to that. I'm not an exception to that. I don't want to be doing that. But in real estate, I can take that same amount of effort that I would have spent, mind share, and I can go buy a building for $3 million, renovate it for 500 grand, and it's worth $5 million. The path to taking my down payment and doubling it over a 5-year period is certain. The probability of losing money is near zero. When I screw up my worst real estate deals, it's like I lose 2%, 3% drawdown. Like that's a bad, if I didn't make any money and I went through all that work to renovate a property, that's a fail. I've had that happen before. Sometimes flips don't go the way you want. You don't make as much money, you make 5 or 10 grand, or you make nothing. And it's like that happens sometimes. But the probability of losing money, I've just gone through the biggest and here in Ontario, we had a 25% drawback. In cottage country, we had a 40% drawback on real estate prices. I just went through one of the worst statistical drops we've had in a decade, and I'm fine. If I had, my stock portfolio is not fine, by the way, in comparison. I mean, I'm doing okay. I'm down I'm shorting the market 2 to 1, and I'm still only down 25% or something. But that's horrible, by the way, and it sucks that I shorted the Nasdaq in a plus 43% year to date. That's the worst timing. If any time I could pick was shorting in May. I guess I was long. I was long in January and February, and then I was covering in February. I was neutral in March for the most part, just collecting decay. There was a few days where I was short, but for the most part, I think I was long for most of April. And then I started shorting again hard in May, and that was a regret. But anyway, it doesn't matter. I shouldn't be trading. You don't try to time the market. You try to buy quality assets, and you find ways to improve them. With the stock market, you can't control the asset. You're not management. With real estate, I'm buying a little business, a little property where I can lean in, put the right staff, the right systems, the right plan in place, and I can actually find a way to guarantee a certain amount of yield, a certain amount of return, because I'm management, I'm in control. And that's something I really like about real estate and just lending too. I mean, honestly, I like lending too, because again, the due diligence piece allows me to manage risk in a way okay, in the lending space, I can't make the returns I can make in real estate. there's no way. Like I can double my money in real estate so much faster than I can in lending. Lending is like more of a stable amount of income, but I can get a really good risk-adjusted return in lending, which is interesting. And it outperforms the stock market, I think, because again, using my network, I can find flippers who are willing to, for the ease and sake of their time, pay me a small premium, maybe 20, 30% more in interest over the year, to not have to go through a bunch of applications and all the time wasted to get financing together. They can make a quick call and I can evaluate the property and it's done, super easy. And for me, I can manage my risk on my side by saying, hey, this building's worth $1 million. I see what it's worth. I'll lend you 700 grand on that. I'm super protected. If the market falls 10, 20%, I lose nothing. The real estate market chops 25%. Again, their equity's gone, but I'm in first secure position. Doesn't matter. So that's where like I'm only doing secured lending now. I'm staying away from anything that's not secured. And I'm very conservative on my loan to values. I'll be very careful. I don't want to be in a position where I can get wiped out, right? It's not good. So anyway, that's my 2 cents of there's so much opportunity in this market. Okay. Ghost Recon says, hi Mike, should I wait to buy my second property or buy right now? When should I start looking at multifamilies? I mean, you should be looking at properties all the time. There should be an offer thrown out. I honestly, at my peak, was throwing out over an offer a day. If you're not writing on offer every day and trying to get something accepted, you're not going to get the deal. So you got to be constantly writing offers and negotiating, and the process can take months. You might submit something, let them chew on it for a while, come back to them a month or two later, say, hey, I'm still interested. Here's where I'm at. Let's get something done. You keep trying and you find them at a weak point and then they'll sign something back to you and then it's under contract. You're in control. As soon as it's under contract with you having conditions, you can walk away whenever you want because you have a condition to walk away on financing or building inspection, whatever. So you're in control now of that deal. They can't back out, you can. That's the position you want to be in. You want to have a lot of deals locked up. You might walk away from some, that's okay. You might assign some to other investors, that's okay. I'll be doing a lot of that too, where there'll be so many deals probably that I won't be able to pick them all up. Some of them I'll just say, hey, this one's got $100,000 upside. Do they want to make 10 or 20 grand? Here it is. Lob them a ball. I make a quick profit. I don't have to close on the property. They close on it. They're happy. They found a deal. That's what you call a win-win. So that's a great position to be in. But you should always look at deals, always throwing out offers. It's going to get better this winter. But you might find something now that's like someone agrees to take 30% off list price for you. And like if that happens, that's a 30% discount. You jump on that because you may not even be able to find that deal. Even if the market goes down another 10%, you may not be able to find a deal that good. So it's hard to say like don't buy anything. I would say it's still an opportunity to buy right now. There are still opportunities. If anything, right now, we could be close to the bottom. I don't know. I think we're getting closer to the bottom. I don't think we're there yet. But there's some really stale listings right now that you can go in there, and there's some desperate people who need cash right now. And that's opportunity. And I love that opportunity. The last 5 years, we've been stuck with like, in the real estate market, the last 6 years, even in London, 7 years, it's like all these sellers can get whatever they want and they can just demand whatever they want. And there's always a buyer, but all of a sudden the buyers are dried up. And so if you're a buyer, you now have the power. So if you're searching right now, just remember, you hold all the cards. Time to pop off, 100% Chung. Garinder says, hope all is well. What are your thoughts on dividend stocks in Canada since they are crashing? Or would you just get a 5% risk-free? So you're talking about GICs. The challenge with GICs is that they are, and GICs for the first time actually have a decent yield, risk to reward. Your risk-free return right now is 5%. But your taxes paid on that are brutal. Like interest income is set up so that you're paying 55% tax. So on your GIC in Canada, you're netting let's say you get a 5% GIC, you're netting like 2.3% net after tax. 2.3 after tax is pretty shit. A 5% capital gain, on the other hand, will net you, like you're gonna keep about 75% of that as opposed to keeping 45% of that. So it's 50% better tax treatment to earn through a capital gain, and a dividend's even better. Especially if you're a low-income individual, you make less than 50 grand a year, dividend income is tax-free on the first 50,000 you earn in Canada. If your income is below 50,000, is zero, and you're bringing 50,000 dividend income, your gross up tax credits from the tax the corporations have already paid on that dividend income, because it's after-tax income, pays those dividends. That tax credit you get equals all of the tax you have to pay. So you end up paying nothing because the gross up tax credit on dividends. So dividends are a great strategy. But once you're wealthy like I am, the tax rate on dividends is brutal, like 30-something%, which is still better than interest income, which is taxed at 55%. The only way that interest income makes any sense and lending makes any sense, if you structure it in a way where you write your note so that it's considered like if you can do a deal with them and it's like a wholesale fee and you throw most of that interest income as a wholesale fee or an active coaching fee. A lot of times I'll do, when I'm letting people, I'll say, hey, this is a coaching fee. So then I get active income at 13% tax. So I'm like, hey, instead of, I'm gonna charge you 6% on the note, that's what we're gonna agree, but you're also gonna pay me and I'm gonna help you through this project. I'm gonna consult with you and you'll pay me 20 grand consulting fee. And that it works out, so I'm getting like 15% interest or 15% yield, but I'm strategizing it in a way where I'm billing them for consulting fees, and that's a much more preferred strategy. Also, another way is structured as a capital gain. So you say, hey, there's a fixed amount of return, but I get 20% of the sale price, the sale profit, or some amount of the sale price over the additional what you bought it for. You can set it up so that it's variable, and so your first mortgage is actually paying you a capital gain. So there are ways to structure it tax effectively, but GICs are not that way. They're always cut and dry. 56% goes to the tax man. Top marginal bracket. It's brutal. Interest income sucks. I would never have a GIC. I would never have any of my money in a GIC. It's the worst possible tax treatment. But if you short term had some cash to park, you couldn't find any home for it, it's a place to put it. It's going to get you a net 2% something after tax. Your 5% becomes 2%, but it is what it is. I mean, it's something. It's something. Sorry if I missed this, but I see a monthly paid membership option on your channel. What are the 3 different options? To be honest, I don't even remember setting that up, but there is a subscription thing that exists. I can't remember the benefits that I set up. I just chose a few benefits for it, but whatever I said on there when they set it up for me, I will honor. So if you do join the monthly membership, there are some perks and stuff like that. Reach out to me. I will send you some cool content. I do want to do something with that. It's like, that's something I should do is these shows, I wanted to make 20 minutes free. The first 20 minutes we do a stream like this. And then I say, hey guys, okay, the end of the stream is coming up. I'm gonna go on the live Zoom. All the members can jump over and we go deep into deals. We talk about stuff I can't talk about publicly online. We talk about the nitty gritty, the secrets, all of that. And we do deal analysis and whatever else. I was thinking of doing something like that for like the other 30 minutes. So instead of spending an hour every week, most of my viewers prefer 20 minutes, I think, anyway. From a YouTube algorithm perspective, it would do a lot better. And there'd be a second component that's like a private course where we have a weekly mastermind, so to speak. So that's something I'm thinking about doing. I don't know what I would charge for that. Maybe like $99 a month or something, or I don't know. But that could be cool. I could also do it so that I took on like 5 or 10 students and I charged a deposit. But I would say, hey, deposits are fundable. We share profit on deals you do. So there's a deposit paid, but as they do deals, we share in the profit on those deals. I coach them through it. I help them find the deals, finance it, all that. We really walk through doing deals together and we share in the profit. I've done that mentee model before. And then, so the reason they do the deposit is so that they don't just flake on you. They have skin in the game and then you refund it based on the profit. So that's something I might do again too. That's a really interesting model where I'm paid based on performance, as it should be. So I don't know, I've thought about it. It's something I should do. The multifamily space is more attractive for me. I'd rather make like huge amounts of money than make like, $800 an hour coaching. I do coaching. If you send me a DM or you send me an email at rosehartcapital@gmail.com, I will do the odd deal analysis call. My deal analysis calls are $897. I'll go over any deal. I've saved a guy before. I told him just not to do the deal, and I saved him probably $400,000 he would have lost doing that multifamily deal. And so sometimes just paying that for the deal analysis is well worth it. The consulting fee is well worth what you would have paid had you not had an expert lean in and help you with it. So it's something I do. I'm happy to do that. If you reach out, I will do one-off calls. I'll do a series of calls. I sell 5 calls for $3,997. If anyone's interested in that, I do occasionally do those as well. You can use those up throughout the year whenever you want. We can do them monthly for a 6-month period. Lots of options there for that. I do it very rarely, but I do enjoy it if I do a few. I do too many, I find it's like a job. So I only take on a few people because I find I'm in my off time, I'm thinking about them. I'm thinking about their deals and stuff. So it takes up space in my brain, even if it's not taking up time. Are any projects coming up for sale turnkey cash flow? DC, yes. I have 3 properties in Sarnia that are 1% rule. So we have one that's close to it. It's $4,000 a month in rent, and we want $390 for the property. So $390,000 for the property. It's rented out for $4,000 a month. My brother is currently watching those. We have a couple of them you could pick from. But the one I'm thinking of we will stay on and we'll JV it with you, or we'll just stay on and he'll do a management fee and you can buy the property off us. Lots of options there. We may just keep that property, haven't decided yet, but because I can find these deals at like 2% real off market, and my brother can renovate them, that's super, great cost. It's hard for me to want to hold even a 10 cap property because again, the churn of my capital. But for those people who don't want to be like grinding the next property, fighting tenants, and like it's an active business of effort. You want a more passive thing. The turnkey is fantastic. You get a great yield. If you put 25% down or 20% down, you get a 20% annual return for 5 years. Your money would double every 5 years with a property like that. I also have a property in London here that I've just been putting up for sale now. I have two actually coming up for sale. One has a guest house in the back, like a coach house. It's a huge lot. And the main house, we put an addition on the roof. We ripped the roof off, put a second story on it. And it's a duplex. So it's a 3+1 on the main floor. And it's like a 1-bedroom upstairs. And so it's got like basically the 3 units there. It's fully vacant. You can pick your tenants on that one. I have turnkey management that will take over the property. She's great. She manages properties for me already. So she would go with the property and keep managing it. It's currently vacant, so we can place tenants or you can have it vacant. It'd be a great house hack too. I got that one coming up. That one's $749,000 for that property, in that range. If I'm writing the offer or we're doing it off market, you can take 2% off for your commission too. So you can save an extra $15,000 in the commission that I won't have to pay. So if you're interested in that, we work out a deal where you get a little bit of a win too. Take 15, 20 grand off the price, and that's a win-win. Same with the Sarnia properties. Hit me up. I got a bunch of those that will sell. A bunch of cottages too. If anyone's interested in cottages, I have like 5 cottage flips that are almost done. I might keep some of those. We're dropping the price dramatically. I have one that has 2 independent cottages on it. It's beautiful in Port Franks. I got another one in Muskokas that's 460 grand. It's the cheapest full season house on an acre of land, beach access, whatever, on 3 mile chain lake in it's near Windermere in Muskoka area, and it's a great deal. I mean, where can you get a full season 3-bedroom house, the bunkie, all of that for like in the 400s? It just doesn't exist. In Muskoka's in that area, like even anywhere near Rosso Lake is like typically $1 million for anything. So there's lots for sale for less. And this property is like pretty renovated, nice and decent. So that would be a good one to pick up too. If you're looking for a cheap cottage, we could hook up a sweet deal on that. It was listed for $629. I think I had appraisal at 1.650. And we're now going for like 4. I'd probably take 450 for it. That's the reality of like, and I'm not gonna cry over it. Like we got a great deal on it. We're still gonna make some profit, but that's the market. Like some people, a lot of these flippers I'm seeing online, just as a comment on social media, are hanging onto their properties and being like, no, it appraises 600. I'm selling it for 600. And so they just hold this property. It doesn't make sense. Move with the market conditions. There's always another deal. Whenever a flipper is holding on to a property and they're not letting it go, because a property will sell within a month if it's priced right and marketed decently well. A lot of them are holding on because they don't have more deal flow. That tells you that they don't have good deal flow. Or it tells me they're having financing issues and they're afraid to like let go of the property. Don't try to squeeze on the sale. Always try to squeeze in the buy. I will let properties go for what they'll go for, within reason. I obviously want the best price I can get. I'm going to try to negotiate. I enjoy the negotiation on both the buy and the sell, but you should negotiate harder on the buy and focus less on the sale. A lot of people, they hold on to these properties, and then in this market, you may end up stuck with a lot of holding costs. You may end up stuck with a property you can't sell, or it sells for less later. So sometimes, usually, the first offers are the better offers. So yeah, those Sarnia properties are off market, so I don't have any links for them right now, but if you hit me up, I could send you a few photos if you're super serious. Like, don't waste my time if you're not ready to go. Next question. Whoa, I lost my spot. Joseph says, hey, I hope you and your family are doing well. How did you find yourself buying foreclosure homes during your real estate journey? Do you recommend them to newbie investors? So I haven't bought a lot of auction homes. It's just not a thing here in Ontario. The banks here are obligated to put on the MLS for a certain amount of time. Like I think it's like 7 days or 14 days where it has to get maximum market exposure. So it's just, they don't exist as much here. They do exist occasionally, but oftentimes it'll be like the real estate agent puts it up and there's an auction, there's a date where everyone submits a blind offer. And that often gets to the point where there's not even a good deal, where they sometimes get bid up a little too high. But yeah, I've bought tons of sight unseens, tons of stuff from wholesale deals where like I didn't even go through the property, went around the outside. It's a risky way to buy real estate. You've got to be an expert to be able to manage through a lot of the challenges you're going to find, like foundational issues and whatever other structural issues you might run into that will be apparent in some of these deals. Just a certain percentage of them are going to have those problems. And it's a numbers game. Like if you do 20 of those deals, 2 of them are going to be garbage lemons. And that's okay. You're going to make money on 18 or lose on 2. It sucks if you only do 1 deal because you may get the lemon. You may get that 2 in 20, that 1 in 10 that is just a shit property you lose money on. And so when you take risk with those types of fixer-uppers, you may get the lemon. If I'm doing 10 of those deals, I know that 9 of them are going to be solid. So I don't care if I get 1 lemon. But if you're only doing 1, you got to pick 1 property. I'd pick something that's structurally super solid. Because again, if you're stuck with that 1 property, it's a bummer if you get a loser on it. Again, volume is where I would go for myself. But I would not start with a more advanced property. I would start with something a little easier, paint, floors, that kind of thing. Hong Kong Fui says, what are characteristics of a good deal? Do you mean look for MLS with good bones, but have comeback issues and then play the numbers game? Yeah, I mean, it really depends, right? Like a lot of the times for me, I would consider a good deal to be something that's currently underpriced or has a value add in some way that allows me to make a play to make money. Maybe it's a basement that's unfinished that I know I can throw a unit in. Maybe it's a main floor that I can split into 2 units by building a wall. It's like a front and back entrance is already there. It's like, wow, 1 wall and a washroom. And all of a sudden we've got a duplex is worth 200 grand more. And I know a wall and a washroom is 30 grand, let's say. So it's like that, an extra kitchen maybe is an extra 5,000 or something. So it's like, I know that I can split up sometimes and get value that way. Or I look at a property with, bad tenants in it or some issue that I know I can solve. That can be a way to make money. So it just depends. But usually there's a value add play. Alex says, hey Mike, are you sure about 30-year loans being assumable? I don't think most of the conforming loans in the US are assumable. Alex, so go look up Pace Morby and look up what he's doing. He does the subject to financing with like hundreds of properties. He doesn't even notify the lender in most cases. So he owns a title company in the US and he's able to do that in the US. So it's a way that you can't do it in Ontario in the same way that they do it there, where like he literally takes over the payments and the bank consenting or not. So I guess watch his videos. He's an expert on that. But there's been several people who have messaged me being like, no, Mike, you were wrong on that. Pretty much any property we can take over and the existing mortgage stays with it. So I don't know. I'm not an expert on that at all. I've not done a lot of US subject to. I've done 1 US vendor finance deal where it ended up being that we didn't assume their mortgage. They ended up buying out their mortgage and they just lent us at like 3.5% or something. So yeah, I don't have a lot of expertise on that in the US, but go and read up on Pace Morby. He does thousands of those transactions. Excited for opportunities this winter going into the new year. That's right, Sean, 100%. Super chat, brother. Coming down to Lundy? Okay. Alex. Harriet says, if you didn't know any contractors, would you search up Yelp and Kijiji? Harriet, the best way to find contractors is through referrals. So you find a good contractor, you get them out there to work, then you ask them if they know other people who are great. Because what I found is that the good contractors also know lots of other good contractors. The bad contractors know lots of other bad contractors. So typically referrals is the way that I like to go. Get one good referral from someone and then go from there and get, hey, do you know an electrician? Do you know a plumber? Can you recommend someone who does flooring or whatever you're looking for, whatever trade it is? But the Kijiji warriors, half of them are garbage. If someone's posting on Kijiji, like the good guys don't post on those places. I've found for the most part. They're so busy, they're so stinking busy, they work on referrals only. So, where can you find the properties? You can follow my stories. I've shared them on there on Instagram. You can email me too if you're super interested. I could send them to you, and you can see if you want me to sell you one. Yeah. Is 14% interest for the year okay for private lenders? SIPO, it is if you're secured. So if you have a first security mortgage or a low loan to value second secured mortgage, secured by the lawyer, not a promissory note, I would say that rate is fine in this market, yes. If it's an unsecured prom note or lent to a corporation, no. If you're, like a lot of these real estate funds are raising capital and you don't own title to the property. You're investing in their fund, some of their equity. It's like, that's a dangerous game. That equity could be worth nothing really quick and you have no security. The lenders will take everything and you'll be what's left over. So I would say get on first secured, get on second security at a minimum at a good, healthy loan to value, and verify the loan to value on that specific property. You can also blanket mortgage, but I would stay away from the mutual fund trusts. I would stay away from all the trust companies, the REITs, the small private REITs. Be careful with all that stuff. Very dangerous. It can be very, very dangerous with the smaller stuff. So, and if you're just lending to individuals like flippers out there, be very careful. We're not in the bull market that we were in before. That kind of risk is way higher now than it was then. In a declining market, only the pros survive. The guys who aren't good at what they do and don't have previous years of success and equity to cover those losses, they may go belly up. So just be careful. I've heard a lot of horror stories recently. Hey Mike, I remember you mentioning you were likely homeschooling your kids. I'm in a pretty similar boat. I reached FI through real estate in my 30s and now want 100% focus on them. That's awesome, by the way. We put our kids in school for a semester this year, 2 of them. One of them's still too young. One of them started junior kindergarten today. We brought them to school. They're in a great Catholic school. It's like almost a private school. It's fantastic. We like the school a lot. We may pull them out this winter. Probably will pull them out this winter. For how long, I don't know. We put them back in again. We're back in Canada. I don't know. What I know is I had a really good talk. My daughter loved homeschooling. She's excelling in it. She's doing really well. All my daughters were super successful at homeschooling. My daughter just wanted to go to school. She wanted to see her friends. She wanted that, interaction. And we do a lot in homeschooling. We were taking them to tons of stuff and keeping them engaged and whatnot. But they just wanted to go, and because my youngest wanted to go to junior kindergarten and try it out. So then my oldest was like, oh, I want to go back to school too. So it's like, we're gonna let them try it for a semester, see if they like it again. We do a hybrid method. So there's no right way, wrong way. If we run into complications and our daughter doesn't like school anymore, in a second, I would take her out and let her explore her interests and do what she wants to do, right? So that's what we're at in our stage. And so hopefully you can find what works for you. And I think the key really to having freedom is like you said, just being able to give your kids the best opportunity. Your second part of your question was sharing thoughts on preparing them for the new world. I think it really comes down to nurturing their skills and their interests. And so to me, you have to teach them how to be able to provide for themselves and for the family. And so a big part of it is incorporating them into what I do so they can understand why I do what I do and how, the way we do things. Like, we are great mentors for our kids. And so that's important. You want to be a good mentor for your kids. What else could I share? I mean, it really just comes down to time and presence at the end of the day. And if school's the right way, awesome. If homeschooling's the right way, awesome. There are people who do the hybrid option. They send their kids 2 days a week. They send their kids in the mornings. They pull their kids out at the end of the day because they don't want the kids to go to art class and gym. They want to pull those out and do those themselves. You could pick your curriculum for your kids. If you don't like teaching math, you think the school is better at teaching math than you are, okay, they can have group classes and they can sit in pods and play with blocks and learn math that way. And then you do the other parts of supplementary education. It comes down to, I think, culture and values. And we are the ones at home who set the pace for culture and value. And so, yeah, for my lifestyle right now, I go to Florida in the winter. So that's one challenge we have as well. Like, our personal lifestyle doesn't fit very well around the school calendar, but we're making it work, I don't know how it's going to play out, but I think that right now I'm just going with the flow, being flexible. Love the bullish energy. Is it better to have a property on a personal name or under a corporation? I've covered this before, but the answer is it depends. If you're gonna buy a fixer-upper property and you're gonna have a lot of write-offs, then your personal name, it could offset your day job income. So you could work your day job tax-free using the real estate rental offsets to cover all the tax you would have paid on your day job. So you can make $100,000 a year from a job and pay no tax. Very little tax. I did this strategy. So it can make sense. If you're in a top marginal tax bracket already and the property's not a fixer-upper, it's a turnkey, and you're gonna have rental income you're gonna have to claim, that's tax you have to pay on that income on top of your existing tax in the top marginal bracket, in which case then the corporation starts to make sense. And from a financing perspective, it's easier to start your personal name, but eventually it gets easy inside of a corporation as you get a bigger portfolio. So the answer is it depends. There's so many variables at play, but the corporation is expensive to maintain, it's extra work, and it's at the maximum tax you can pay, equivalent to the max bracket in your personal name. So do with it what you will, but there are ways for both that make sense. If you're always buying 5+ units, I would say always in a corporation. Mara says, are you happy, comfortable, or both? Currently happy and comfortable. Chuck says, what are the main things that you're considering when you make an offer? For me, it's all about how can I make money? How can I get this at a price where my risk is low and I can make money? I think risk is probably number one. Like, how do I mitigate risk? Second is how do I make money? When I'm writing an offer, so it's all about risk and money. Thoughts on building wealth by creating businesses versus real estate? Both are great ways. Real estate is basically a little business, so they're analogous, they're very similar. I would say both are great ways to make wealth. You're not gonna, I know very few people who have made it from zero to billionaire trading. There's lots of people who have made it to be a billionaire through business ownership and building value in a business and creating systems and do it through real estate too. Very few through things like trading. But building businesses is a great way to build wealth. It can allow you to 10x your trajectory. As a Canadian with a mortgage and a house in Canada, when rates go down, can I get long-term fixed rate mortgages from the States? No. So you'd have to go through your broker here in Canada, and we don't have 30-year fixed rate mortgages in Canada, so you're kind of SOL. Shit out of luck. You can do a 10-year fix, but it's expensive. It's something you could look into. I probably wouldn't fix in for a long time. I'd wait for rates to fall first. Wait for there to be this bullish energy in the lending community, because there's not right now. It's very bearish. Okay, I gotta wrap this up. I gotta go. I'm past my time. Talk about a platform for options. There's a free one called Tasty Trade. Tasty Trade is fantastic. It's a great options course you can take and learn about. How do you confidently determine the FMV, which is fair market value, if there are comps that aren't very similar? You have to do an oranges to apples comparison. So you'd have to equalize the properties. So if one had a garage and one didn't, well, they're typically appraisers would say, okay, a garage is worth 20 grand, or you look up what it is based on the number of bays and the size of it. How many is a 2-bay car garage, 3-bay garage, whatever. You equalize it. And so if it's different square footage, you can get a price per square foot, equalize it for bathrooms, bedrooms. That's what the appraisers do, is they make it as similar as they possibly can. All right, storage facility, that's cool. How would it affect a rental property there? I mean, kind of depends. Like, I don't know if storage is a negative thing, really. Like, low-income housing would be a negative thing if you had an A-class property. If you already had a C-class property in that area, I mean, it doesn't really matter. More C-class rentals doesn't hurt you negatively, really. It depends. It's so hard to say like one thing is good or bad, but probably not that. I don't invest a lot in the Highbury area at all, but not that big of a deal, I don't think. I don't know, I have to drive through the area and see what we're looking at as far as like what currently exists in that area. If it's already a bunch of commercial stuff, it doesn't matter. Usually people investing into an area increases and gentrifies the area. So people are dropping big money and making a really nice storage facility that might clean up the street. If there was like homeless living there before, like some shitty old dilapidated houses, depends what was there before and what's there now. I can't say for sure whether it will increase value or not, but it may not have that big of an impact at all, to be honest. What are your thoughts on the Airbnb market and the potential slowdown? I think there's opportunity there too. It's great. I'm seeing a lot of re-rental people message me saying, hey, I rented this property for $1,000 a month. Some months I'm making $1,500 a month profit. Some months I'm losing because I'm paying for management staff, paying for cleaning, I'm paying for damage and wear and tear on the apartment and repainting, I'm paying for new furniture and stuff. And it's like, man, like I'm losing money. So I hear stories like that. Then I hear other stories where people are still doing well with it. I think it's a mixed bag. Some people are having a lot of success. Some are having less success. In general, bookings are down. Dollars per night are down. In general, people aren't traveling. It's a recession. Things are not great. I mean, technically we're not in a recession, but like it's a recession. If you walk around outside and talk to people, we're in a recession. So yeah, I'll leave it at that and say that's all the questions for today. And in general, wherever I see things are declining, like Airbnb, that's an opportunity. When things are crashing, most people walk away. When everyone is fearful is a time to get greedy. When everyone's greedy is a time to be fearful. It's a great quote. I like it. I live by it. Should be your investment philosophy, guys. If you're watching this, you're one of the 40 people that watch us, you didn't hit the like button, hit it now. So I clap, say thank you for the presentation. I'll see you guys on all the other social media places at Mike Rosehart, blue checkmark, Instagram, Facebook, etc. and so forth. Yeah, thank you guys for watching tonight. And remember, the secret to unlocking wealth through you is 3 levers. You're in control of your financial future by spend less, earn more, and maximize returns on that difference. That's it. Secret. Have a good night, guys.